Hello friends, welcome. Friends, we know that US and China, both the countries are in a trade war, and basically they are trying to negotiate better deals than what they have given to each other. And US is trying to arm twist China, and the process is on, and Mr. Trump is going to ensure that he gets the best deal. Now, when this whole action is going on, both sides are playing their own game and trying to create as much leverage that they can so that they have a better position on the negotiating table. That's how this game is played. Now, in the morning, when I was going through the news articles, which I saw that yesterday, on 17th April 2025, there was a headline by Bloomberg. And this headline says China stock to face $800 billion of US selling in extreme case, right? And this article is a paid article, so I don't have Bloomberg subscription. So I went to CNBC and I saw the same headline and I went through this article. And when you go through this article, you will find that there is a term called ADR. Right? And then there are certain numbers, right? US institutional investor currently own Chinese ADR of around $250 billion, Hong Kong, so and so. So some numbers are being thrown and people might not get a very good idea as to what is going on. So friends, this is the whole purpose of this video. Because when you are talking about China is in the face of huge pressure of US of offloading 800 billion of US stocks. Somebody can say that there is $700 billion of US Treasury bonds which China also holds, right? So China also can dismantle the US Treasury market by offloading those bonds, right? So there could be tit for tat on both sides, but the game is not even here. This is exactly what we are going to understand in this video and see who has the leverage in this game of offloading each other instrument. And friend, this is going to be a very, very interesting video because this will be loaded with data. Now, in order to understand this whole thing, which will be very, very difficult for any person who doesn't have the background and who has not seen the number, for them to understand, I will make it easy. So what I've done, friends, is that I actually have created certain PowerPoint slide. And I'll start with the concept of ADR first. So let me just move all this instrument out of the picture. So let me just talk about what is ADR. So this is what the slide looks like. And I am going to make it, I'll just blow this a little, so that, you can understand, we can see this. I'll put my face here a little bit. So what is ADR, right? ADR is American Deposit Receipt. It's a certificate issued by US bank representing foreign shares. It's a very, very interesting term, right? It allows foreign companies to trade on US exchange, New York Stock Exchange and NASDAQ, traded in USD like the US regular stock. So it's not an exact regular stock, but it is almost like a stock because the scrutiny is done by US bank. And anybody wants to list in the New York Stock Exchange, the foreign companies which have a lot of problems in transparency, account verification. So people has to go through a lot of regulatory, challenges when you go to the New York Stock Exchange. So they go through a bank which are better equipped to do all this scrutiny. So this is called ADR, right? Now there is another term called SLT. Both are very important because both are going to be a part of my analysis. So here you have to look at what is SLT. So when you look at SLT, what is the full form of SLT? It is Security Long Term Reporting System. Because those numbers that you saw in the article CNBC, you have to see those numbers live. You have to see how the numbers have been changing over a period of time. Then only you will understand who has how much leverage. And that you will only be able to see on the reporting system, which is called Security Long-Term Reporting System. And this is part of the TIC framework, which is called Treasury International Capital System, which kind of aggregate all this data, track holdings, long-term securities of US residents holding foreign security and foreign residents holding US security, published monthly by US Treasury, sorry. So then I will show you that we are going to basically go to three different type of tables. I'm going to show you three different types of table. So table 1 is US long-term security held by foreign residents. Table 2 is foreign long-term security held by US resident. Table 3 is US Treasury held by foreign residents, right? Now, what is the structure of these tables, which is important to understand, because without looking at the structure of these tables, you will not be able to get how complicated the data is. Now, this is the table 2, foreign long-term security held by US resident, and this is the kind of structure it has, and you will see the countries on this side and the numbers here. So you have to aggregate this data in order to get a time series view, which I have done. Similarly, for table 1 also, this similar kind of table exists. So friend, in order to make this discussion much more efficient, I already have these tables captured in my website. So this is the SLT1 table, and this is the structure of the SLT1 table, which is quite easy to understand because there are time series. You can basically pick month, quarter, year, and then we have got SLT2 table, where also you can do the same thing, where you have foreign long-term security held by US resident. Now, first we will focus on SLT2, which is foreign long-term security held by US resident, because we are talking about offloading of Chinese securities by US residents. So that we need to understand how much Chinese security the US residents are holding, from where we can get the data. So what I've done is I have chosen the foreign corporate long-term security stock holding. So if you choose this, you will see that for India, this number is $325 billion. And for China, this number is $235.9 billion, right? Now, this is 235, but this is talking about, this article is talking about $800 billion. From where this $800 billion is coming? That is a question that we have to answer. For that, I have to go to page 1. So when I go to page 1, you will see that for all countries, this is $12.5 trillion, because there are 3 different items here. Foreign, corporate long-term stock holdings, the total foreign bond holdings, and total foreign security holdings, right? So this is one, this is the second, and these are the total, right? So I'm only interested in the stock holding. So if you do stock holding, because stock is the major component of US investment in foreign countries. They generally don't invest in bonds, because if you look at the bond holding, you'll find, let me just show you the bond holding. The bond holding data is less. The stock holding data is high, which is $12 trillion. The bond holding is around $3 trillion, right? And China's, when they're investing in China, they are investing mostly in bond holding. So if you look at, you'll find that most of the investments are in the Cayman Islands, the Cayman Islands. So this is $2.1 trillion. Now, this is an indirect way maybe to invest in Chinese stock market, because direct investment is roughly around $250 or $231 billion. So this $800 billion number can be indirect, either through Hong Kong or through other tax havens, right? So I'm not going to get into that. But the discussion is pretty important, is because of the fact. So let me just go to the main part of my presentation. So this is my presentation where I'm saying that US-China tariff war and the capital market brinkmanship, right? So let's go to the next slide. So the context and the surface story. So I showed you the number of SLT2 and how you can basically evaluate the holding, and you'll see that the China holdings are roughly around, so it has not gone down, and even the Cayman Island holdings also are going up. So US is heavily invested in foreign markets, and there is a lot of investment in the Chinese market also. So if there is a delisting threat, right, which is targeting 250 plus Chinese company, and the Bloomberg report of $800 billion in extreme scenario, is it a real threat or calculated negotiation? So the real play of US capital as a weapon. So US capital market gives Chinese firms global visibility. So these are the advantage: access to cheap and deep capital, prestige and legitimacy. Delisting means cutting off this oxygen, a credible threat which will hurt China more than US. Why? Because as soon as there is an offloading of $800 billion, those companies which are invested in the US stock exchange through those ADRs, their valuation will plummet. And when their valuation will plummet, they will find it very difficult to find another listing place in the global market, because it is very easy to take out money from the US market, because capital inflow and capital outflow in US market is quite easy. It's free flow. But China, there are a lot of regulation. You take the money in, then you take the money out in a different market. You have to go through a lot of regulation. So it is going to break the backbone of Chinese company, and really it is going to have a huge amount of exposure, risk exposure. So Chinese exposure, what are the risks? 250 billion of Chinese, it may be more, it is $800 billion. So you can play with the number, it doesn't matter, right? Held by US investor directly. Then there is $100 billion Hong Kong listed share. Then the Cayman ETF exposure. Delisting will force sell-off, valuation crash, credibility loss, capital outflow, reversal hit, and global perception also will get hit. Now, why US can absorb the shock? It's important to understand that if the China is, when the US investors sell off those $800 billion, will the US market will also get hit in the same manner with the valuation of these companies, the Chinese companies are going to hit. Who is going to be hit more? So this slide captures the overall balance. The US equity market is around $40 trillion and it can digest $800 billion sell-off very easily. Because this is like a peanut, this money can very easily flow because the capital inflow outflow in US is very easy. So US market is not going to feel the impact, but the Chinese companies are definitely going to feel the impact. The institutional investor just rotate their equities, no systemic risk, the US capital stay in US ecosystem. For the US delisting is a pressure tool, not enough. Maybe it is just a negotiating tactics. Now, what is China's counter option? This is where I am going to go to the next table, which is SLT1. Now, in SLT1, what is this? US long-term security held by foreign residents. Now, you have to basically see here. So, when I say Treasury, because Treasury is where the maximum investment in US happens. So, you see the total all country is around $7.4 trillion. Here, there are many other options. There are LT bonds, LT equities. Total US long-term security we're talking about, it is $32 billion, total US long-term. But if you're only talking US Treasury, LT Treasury, it is $7.4 trillion. Now, if you look at China mainland, and if I do total, let's see what the difference is. Total long-term US security, and if I do China, where is China mainland? It is $1.2 trillion, right? Now, if I do only US Treasury, let's see what the number is. China mainland number. Here it is $707 billion, right? So, if you see that, and what else China has invested here? US if this is total, US agency long-term LT bond, China is $207 billion. And then we have, US corporate long-term equity. China is not there in the list even in this first page. And the US corporate long-term equity, China is not there in the first page. So China is invested in US treasuries and they are invested in US LT bonds. Because if you see that is $207 billion, and if you add out everything together, that comes out to be. So let's do the total and see what the number is. It is $1.2 trillion, which means that 700 plus 250 plus something. So it is mainly treasury plus something, right? So the impact is more on treasury, which is what? The $700 billion. So if you look at here, China, where is China mainland? $700 billion. Now, this is where the maximum amount of impact China can cause to the US bond market, right? Because China has been divesting this slowly. They are not doing it, in a drastic manner. Because if you look at this is FY14, it was $1.2 trillion. Now it is $707 trillion in FY25. So China consciously is reducing their exposure in US Treasury because this is where the maximum foreign reserves are invested, right? So let's go to the slide and let's understand what is the counter option that China has and why they are weak, right? So as I said, that China holds $707 billion US Treasury, which is 7% of the foreign stock held, right? Dumping US Treasury would crash its own RMB. Why it will crash its own RMB? Because let's say if you are dumping US Treasury, then you will create a demand for what? Your money is going to, the dollars are going to flow in China, because when you are offloading that, you are basically what you are doing, you are selling off, right? And when you are selling out, you are earning in dollars. So demand of dollar is going to increase, but the RMB is going to basically crash, and it will hurt domestic firms' dollar funding, and significant panic and global trust, and US Fed can offset that impact because this is only 7%, right? So it is not going to crash the US bond market because the US Fed can do an open market operation to prevent the crash and take away all the selling that China has done, and then absorb the selling and inject more fund into the US market. That's all they will do. So China's counter options are pretty weak. So this is a summary slide, the strategic asymmetry. Capital market. So US leverage is what? US leverage is capital market is an offensive tool. China is mostly passive. Treasury exposure, it can absorb, US can absorb the risk by doing an OMR, but it is going to completely dismantle the value of China's foreign exchange asset because it is going to make that, because as soon as you sell those, you will not be able to recover the full value of those assets because the prices will definitely drop in the short term because you are going to make the first move. Investor behavior, they can reallocate. US has the leverage because even if they sell it, the stock market is $40 trillion, those 800 is like peanuts, But China is going to face a huge friction because of capital inflow and outflow. They will not be able to reallocate those delisted stock in a different exchange. And geopolitical optics is also going to be very important. Transparency, framing, because what happens is why anybody invest in US market and why they get a better return, because US listing is always a sign of transparency, and therefore you get better value. But if you are going to invest in China, your value, if you see the multiple which Chinese companies get when they are investing in China, the Chinese stock multiples are always low, right? So if China, if from a geopolitical optics point of view, US is transparency and China is seen as a weaponization. So the final summary is, it's a game of bluff and pressure. So this is brinkmanship, not an immediate decoupling. This is a US testing Chinese tolerance via financial threat. It's a clear financial threat. China is cautious, retreating from treasuries. It is not retaliating because it knows that it can't offload treasuries in a drastic manner. It has to do it in a very, very slow and steady manner, and then replenish those treasuries using different instrument, maybe buying different currency or gold. So they are doing it in a very continuous manner, and they are consciously taking away their money from US Treasury. Goal is to bring China on the table with minimal cost to US. So that's all the game is going on. The road ahead is that we have to watch for more leaks and rumor. We have to see what is going on as far as ADRs are concerned. China is accelerating gold and RMB trade initiative, and we don't know what's finally going to happen. Just for the for the last bit of it, I would like to show you that what is happening as far as gold buy is concerned. And this is a very interesting data set that I have. Let me show you that what is going on. This is data set from World Gold Council. I'll take a yearly time scale, and you'll see that China has a total gold reserve of 2290 metric ton, and they bought 1235.4 metric ton from FY16 till FY25, right? Within this period, there is a buy of this much metric ton. So China has been accumulating gold significantly. Their overall gold holdings will be roughly around 8% of their foreign exchange. So they are consciously trying to divest away from US dollar into different instruments. So China knows the game pretty well. US also knows what kind of strength they have, and that is why this headline is important. This is a threat tactics. I don't think it's going to get executed. It is a part of the negotiating game, and I tried my level best to give you the larger picture by looking at the various data points, and I hope that you understood it. And if you have any questions or any comments, let me know in the comment section, and I'll come back with it. And thanks for listening to the end, and I'll come back with a new video next time on a new topic. Thank you very much.